To the COVID-19 presentation. COVID-19's impact has been sudden and pervasive, and Sherry Beckert would like to be your guide forward during these unprecedented times as we discuss the accounting and financial impacts of COVID-19 and answer some of your frequently asked questions. Hopefully after this conversation, you'll be able to summarize certain financial reporting and regulatory changes, explain some of the accounting impacts, and identify some of the additional disclosures that might be necessary. But before we begin, let us introduce ourselves.
Hi, everyone. I'm Jessica Helms. I'm a senior manager in our Atlanta office. I work in our professional practices group, so I spend some of my time working with clients, such as helping them implement new accounting standards or dealing with technical issues. But most of my time is spent working on internal projects, such as policies and processes related to our audit.
And I'm Michael Hoos. I'm also a senior manager in our audit professional practices group based out of the Raleigh, North Carolina office. I spend most of my time dealing with technical consultations on engagements and developing internal content and external content such as this.
Okay, so to get started, when we were putting together the information for this discussion, we thought there was an important distinction between topics that will affect fiscal years that ended before the true impact of the coronavirus was known, and those years or interim periods that were in process when this really became a big deal. So we want to start with the first of those groups of financials. So this category will mostly cover impacts related to 12/31 period ends, where maybe you haven't issued your financial statements yet. So talking about information that comes out after the end of your reporting period, the first thing that probably comes to mind is subsequent events and how those should be included in your financial statements. So there are two types of subsequent events. The first one, type 1, are events or transactions that provide additional evidence about conditions that existed at the date of the balance sheet. So these are also known as recognized subsequent events because the information is then used to adjust the balances in your financials. And that would include using this information to calculate your estimates at the end of the year. So an example of this would be if you had ongoing litigation during the year, but you didn't know the exact amount of a settlement until the beginning of the following year. So if that amount becomes known before you issue your financial statement, that final amount should be recognized. Then there's also type 2 subsequent events. So these events provide evidence about conditions that did not exist at the date of the balance sheet, but arose subsequent to that date. So these are non-recognized subsequent events, and they lead to disclosure in the footnotes only. So using the same example, the litigation would be subject to disclosure only if it related to something that did not occur until after the end of the year. And so determining whether an event is recognized or unrecognized can be more difficult in times like this when circumstances are evolving versus just evaluating a single isolated event that occurred. So when events are developing over a period of time, some portions of the impact may be recognized while others are unrecognized. So is COVID-19 a type 1 or a type 2 subsequent event? The consensus is pretty much that for calendar year-end companies, any subsequent events related to the coronavirus outbreak and the impacts of it are likely to be type 2 and recognized as footnote disclosures only. While the disease was first reported in December, there was really no indication of the pandemic status or sense of the magnitude of the impacts until later on, meaning those conditions did not exist during the year. So this is for calendar year-end companies. The conclusion might be different for a company with a later year-end, say a February or a March year-end, as more information would have been known during that fiscal year. So assuming this would be a type 2 subsequent event, what needs to be disclosed, if anything? So generally, a subsequent event should be disclosed with some sort of information if it meets both of these criteria. So first, if the event has a determinable significant impact on the balance sheet, either at the time of occurrence or on the future operations of the company, even if they're not exactly quantified. And then also that the financial statements would be misleading if the item was not disclosed. So if this situation is having no impact on your company, first, you should consider yourself very lucky, but also know that there is no requirement for you to disclose anything in that case. If there is an impact that should be disclosed, you must disclose the nature of the event and either an estimate of the effects or a statement that an estimate cannot be made. So let's look at a couple example disclosure of subsequent events. So these two examples both come from 10-Ks from public companies that had 12/31/19 year ends. So this first one here you can see is very generic. It says, as a result of the spread of the COVID-19 coronavirus, economic uncertainties have arisen which are likely to negatively impact net interest income. So it gives the nature of the event, which is the spread of the coronavirus, and it explains the impact, which is hurting interest income, and then explains that the total impact is unknown. This next one is a lot more detailed. So this comes from United Airlines, and this disclosure actually gives some real data about the cancellation of flights, how much of the company's business this will impact, and then it shows what they expect as far as declines in their demand. So then similar to the other one, at the end, it notes that the overall impact is unknown because this is all very, very highly uncertain. Nothing can be predicted. I think an important thing to note here with United is that they filed their 10-K in February. So this is all based on information that was known at that time. So you would think if they would have filed later, there might be even more information or new because the situation is constantly evolving. So that brings us to our first polling question. Michael, if you want to go through this.
Yep. So which phase of financial reporting are you all currently in? Have you already issued your 12/31/19 financials? Or maybe your 12/31/19 financials are in process? Or you don't have a calendar year end, so you haven't yet started, or you're working on interim reporting such as a public company? Give everyone a few minutes to answer that, a few seconds. All right, hopefully everyone's had a chance to answer that. Are we able to see the results of the polling? Oh, okay. So about 45% do not have a calendar yet and not yet started. That's interesting, a little surprising. And 30% are financials are in process. So only 21% have already issued their financial statements.
Okay, very interesting. So the next topic we want to go through is related to taxes. And the thing with taxes, the valuation allowance here is the only item that will affect 12/31 financial statements. Other items will be only on a go-forward basis. So with taxes, ASC 740 requires you to reassess your valuation allowance on deferred tax assets at each reporting date and use all available evidence in making that assessment. So all available evidence is defined as historical information supplemented by all currently available information about future years. So subsequent events that occur after year end, but before the financial statements are issued, should be considered when estimating the valuation allowance. An important thing to note here is that this is different than with most other impairments, which Michael will talk about later. So other impairment analyses utilize information only from what is known at the end of the period. So your information used in determining your valuation allowance should be consistent with what is used in evaluating going concern, which we'll talk about in a minute, but it should not be the same as what's used in assessing impairment of assets. So then changes in tax law, again, only impact going forward. So this has no impact on your 12/31 financials. So any changes in the tax provision due to changes in tax law are only recorded in the period in which the tax law change is enacted. So any changes that occur subsequent to the balance sheet date but before the financial statements are issued should not be considered in the tax provision. And this is true even if the tax law change is retroactive. So there should be no impact to 12/31 provisions related to any recent tax changes, but you are welcome to disclose the potential impact of any material change. So going concern. So when you prepare financial statements, either for annual or interim reporting periods, GAAP requires that management evaluates if there are any conditions and events that raise substantial doubt about the company's ability to continue as a going concern. And this evaluation has to be performed for a period of 1 year after the date that the financial statements are issued, not 1 year after the date of the end of the reporting period. So this evaluation must be based on conditions that are known or reasonably knowable at the date the financial statements are issued. So this means that once any information about the coronavirus or related closures related to that was known, the related impacts must be built into the projections for evaluating going concern. So with the situation changing so frequently regarding closures and just different circumstances related to the situation, this evaluation and the determination of reasonable projections can be extremely difficult. So if substantial doubt is identified but is then alleviated through management's plans, say raising capital, issuing debt, cutting costs, there still might be significant additional disclosures that are required in the financial statement that explains all of those factors and the plans for the company. So depending on the significance of the impact to your company, disclosure in the footnotes or of a subsequent event or a liquidity disclosure, it might not be enough for your auditor review report. And so there are a couple of options that your auditor might choose to use. The first is an emphasis of matter paragraph. So if the auditor decides that an event has such a material impact on the company that it's necessary to include an emphasis of matter paragraph, and that's just a paragraph in the audit report that directs the reader's attention to the disclosure of the event and the effects in the financial statements. So a major catastrophe or the situation that we're in now is an example of when an auditor might consider it necessary to include this emphasis of matter paragraph. And so this paragraph will just refer to a disclosure that's already in the footnotes. In this situation, probably the subsequent event footnote. The other potential change in an audit report or review report related to this would be a going concern paragraph. So we talked about going concern. If there is substantial doubt about the company's ability to continue as a going concern for a year from the report date, the auditor will include a paragraph indicating this. So if the substantial doubt was alleviated, meaning there are plans in place to improve the financial position, the auditor may still include this emphasis of matter paragraph to direct readers to information on the company's liquidity and then management's plans related to those matters. But if a substantial doubt remains, then the auditor will include a paragraph in the report indicating that this substantial doubt exists. So that brings us to our second polling question. Which of these do you think will impact you the most? Either subsequent events, going concern, impairment, or other? We'll give you guys a few seconds to get that answer in so you can get your CPE credit. Maybe a few more seconds for everyone. Okay, Christy, do you want to go ahead and close the poll? Okay, so it looks like most people, 54%, are saying subsequent events, going concern at 14%, and impairment at 11%, with 21% saying other. So I think it definitely makes sense with subsequent events being the highest percentage, just with the timing of everything. But now I'm going to pass it to Michael to talk about some other impacts to the financial statement.
Thank you, Jessica. So let's kind of jump right in with impacts to later and future financials. So this would be for clients that have not yet had their fiscal year end, which sounds like that's the largest group here, or those that have had their financial year end but have not yet issued, or those who are contemplating interim reporting, like public companies. And also, I would say that this is also for, depending upon how long this crisis lasts, this could be considerations that need to be thought of for the 12/31/20 calendar year ends. And also, if you are reporting to those charged with governance, you're going to want to make sure that you set expectations appropriately about impairments that might occur and that sort of thing. So with that, let's go ahead and just kind of jump right into it. And the first thing that I would like to talk about under this category is business interruption insurance. So that's typically the kind of questions that I get when we have a sudden impact, such as a hurricane or that kind of thing. And first, I want to talk a little bit about, business interruption insurance in general. And typically, that will cover a gross margin that might be lost. Also, it'll cover a portion of fixed charges. It'll also cover some other expenses that might have been incurred to mitigate a business interruption, such as temporary facilities, rent on those facilities, equipment, subcontractors, that kind of thing. What I encourage everyone to do, though, is to read your policy very carefully to determine if the item is covered. So some policies contain broad exclusions for damage caused by biological agents. Those exclusions are usually written in either a standalone provision or incorporated into a pollution and contaminant clause. Some policies only partially exclude biological agents. So sometimes they might cover bacteria but not viruses, or vice versa. Additionally, many policies will contain a coverage limit or have a waiting period before the coverage kicks in, or both. But if you do have business interruption insurance and you believe it will cover some of the interruptions that are occurring, the first question that I get usually is the gain recognition. When can I recognize the business interruption proceeds that I will get? Well, the classification will tell you that business interruption insurance should not be recognized until it's realized, which would mean when it's received and there's no expectation of repayment or refund, or if the insurance carrier has acknowledged that the claim is in fact covered and communicated an amount that will be paid, and there's no caveat like pending final review or something to that effect. And then at that point in time, you can recognize the gain. And then the next question naturally becomes, well, what's the presentation of that? And so there's several issues to think about. One is, as we're going to talk about in the next slide, unfortunately, sometimes there might be liabilities that are recorded for such things as termination benefits and that kind of thing. And so the question becomes, can I offset some of these liabilities with the expected receivable from my insurance? That is unfortunately not allowed for. The offsetting rules in the codification require that items can be only offset if they are with the same counterparty, which is usually not the case in business interruption insurance. The presentation on your income statement is a policy election. So you can present it on your income statement from continuing operations as a operational item, either offset to expense or other income, that kind of thing. On the cash flow statement, generally it's going to be an operating cash flow. And then disclosure, of course. So in the period in which you are going to recognize an insurance recovery, you need to disclose the nature of the event that resulted in the interruption losses that were being covered, and the aggregate amount of the interruption insurance that you received, and the line items in the statement of operations that those proceeds are categorized as. And like I mentioned, unfortunately, the other item that I typically get asked about in sudden events such as this or macroeconomic downturns is, unfortunately, termination benefits. And the accounting for termination benefits depends upon the nature of the termination benefit, specifically whether the termination benefit is voluntary or involuntary, and whether it is pursuant to an already existing plan or not. Voluntary or special termination benefits, the first row at the top, that arises when an employer offers for a period of time certain additional benefits to employees that will elect to voluntarily terminate. A liability should be recorded and an expense recognized immediately in the period that the employees irrevocably accept that offer and that the liability is reasonably estimated. it would not be appropriate to record an accrual based upon an estimated acceptance rate, or it would not be appropriate to record an accrual based upon acceptances that happened subsequent to the balance sheet date. So it would be a non-recognized subsequent event. The next category, the next row down, is involuntary termination benefits that are provided for based on an already existing termination benefit plan. So either it's written or it's based upon consistent practice. There's a mutual understanding between the employees and employers regarding these benefits. And these should be recognized when it's both probable that the termination event will occur and the amount can be reasonably estimated. And for these type of arrangements, this is generally achieved when a plan to terminate employees has been established, and any uncertainty that might exist regarding the timing of those payments would not preclude the recognition of the liability. In addition, because these benefits are predominantly associated with past services, and they relate to a previously understood arrangement, the expenses are generally recognized immediately, even if there's a insignificant future service requirement in a week or two or something like that. And the third category is involuntary one-time benefits. And so these are benefits that are not provided under some pre-existing mutually understood plan, whether written or just by business practice. And these benefits are recognized when management commits to a plan, the number of employees has been decided. It doesn't have to be the specific employees, but just kind of a general number and job descriptions, that sort of thing. And the terms of the termination benefits are sufficiently determined to estimate those benefits. And the termination date has been decided, and it's unlikely to be any significant changes to the plan. In those situations, you would recognize a liability, and you would expense it either immediately if there's no future service requirements, or over the period of service if there is some future service requirement, like you must work for the next 60 days, 30 days, even 6 months, something like that. And so that's how you would record termination benefits. Hopefully that's a little bit helpful. The next area that I typically get questions about, and I think we're going to get a lot of questions about with COVID-19 and the stimulus package, is accounting for government assistance. Now, I'm not going to spend a lot of time talking about this, and you'll find out why. So, government assistance can take a variety of forms. It can be direct grants or subsidies. It can be loans, below market loans, at market loans, forgivable loans. It can be all sorts of things. And unfortunately, U.S. GAAP actually contains no specific guidance on accounting for government assistance. Thus, determining the proper accounting treatment will be very challenging and judgmental, and based upon the facts and circumstances and the nature of the assistance that's being provided. Whenever there's not direct authoritative guidance, you're supposed to use analogous guidance. And so these are kind of the three categories that I typically see. You'll see some guidance that's applied under ASC 740, which is income taxes, and that's generally, when the assistance is through a taxable event, or if there's a traditional loan that's, not expected to be forgiven under traditional loan guidance under 470, or interestingly through the non-for-profit contribution guidance that is 958605, or there's actually a international accounting standard, IAS 20, that is sometimes used by analogy, that is directly related to government assistance to private entities. And so, again, not talking too much about this, but just be prepared that there will be some diversity in practice, and you'll probably end up having a disclosure about the fact that there is a lack of authoritative guidance, and you have to assess some of this assistance through analogous guidance. And so with that, I kind of want to move on to, the area that we're probably all thinking of when we first thought of some of the accounting impacts, and that is, impairment. And a lot of the slides we're going to talk about impairment and that kind of thing. And on this one, we're going to talk about, goodwill impairment, impairment to indefinite-lived intangibles and long-lived assets, that kind of thing. The thing I want to just kind of refresh everyone's memory is that, whether you're talking about goodwill, indefinite-lived intangibles, or long-lived assets, or, accounting for under ASC 350 or 360, or if you use a private company counsel alternative, it doesn't really matter. Every single long-lived asset is going to be assessed for impairment whenever there's a triggering event. And COVID-19 will present a pretty pervasive triggering event for many different assets. I might want to kind of point out that for goodwill, one of the things that you need to consider is market capitalization. So if you're a public entity, and you can have visual into your market capitalization, if you compute what your market capitalization is, and that is less than the book value of equity, then it's a pretty good indicator that there's an impairment. And unfortunately, the codification doesn't allow for an argument to be made that, everyone is experiencing, a decrease in their market capitalization. That's not a sufficient argument from a GAAP perspective to state there's not a triggering event, because everyone's suffering through that. Some of the other things I might want to touch about, updating your projected cash flow. So, most of the impairment analysis are done with the income approach, specifically the discounted cash flow approach, where you put out cash flows for the next 10 years, and you present value them. And so some of the things to think about are, you're going to have impacts to both your outputs and your inputs. You're going to have demand changes, obviously, distribution channel disruptions. You're going to have unavailable supply or delayed supply, or maybe higher costs in supply if you have to use alternative suppliers. You could have impacts to your labor. If you're a business that requires a physical presence, you could have people working remotely and decreases in productivity. You might have contractual requirements that are now going to be onerous to you, because they might be long-term supply agreements with minimum purchases that are still going to need to be upheld. And so, these are some of the things that you need to consider. And then lastly, you're going to need to consider your discount rate. So the discount rate in a discounted cash flow analysis is supposed to not just be kind of the incremental cost of borrowing, but really it's supposed to assess the variability or the risk in the cash flow. So it might be that you need to have a higher discount rate when computing your present value of your enterprise, because you have to take into account that there's a much greater risk that these cash flows that you're projecting will not be accurate. And then the next question that I typically get with, talking about goodwill and other intangible impairments and stuff is, the order of impairment. So, goodwill impairment is essentially taking the fair value of the reporting unit, comparing it to the carrying value, and then if it's greater than or less than, you would have an impairment of goodwill. And so in order to do that, you first have to get the book value of your enterprise correct. And so that's why goodwill is last on this list. And the first thing that you would do is go through your normal assets and liabilities that are not covered by 360. So this is your receivables, this is your inventory, that type of thing, right? I call them your everyday assets and liabilities. And then the second would be your indefinite-lived intangibles that are not goodwill. So you're talking namely your trade names, things that are not amortized, they have an indefinite life. And then the third category before we do goodwill is your long-lived assets within the scope of 360. So that means your physical tangible assets like your property, plant, and equipment, and then your amortized intangible assets would be the next thing. And so that order of impairment is important because it will impact your book value of your goodwill. And of course, that will be the deciding factor when you determine if there is an impairment or not. So let's move on to financial assets. That's another area where there could be significant impairment and that kind of thing. And so the first most common questions that we get are related to equity instruments. And I'm going to pause talking about that a little bit because we all know that equity instruments are measured at fair value with changes in value reported in earnings. But there's two common questions that I get that we'll talk about in the next couple of slides. So I'll move on to equity instruments that are accounted for under the alternative measurement method. And so that relates to namely investments in private entities or equity investments that don't have a readily determinable fair value, or we're not accounting for them under the NAV alternative. So ASU 2016-01 established that you could use essentially a cost basis, but you would have to adjust for fair value changes if there was an impairment. And one indication of an impairment was an observable price change in a transaction related to that entity. So what I'm expecting, and many folks are expecting, is that some private entities are going to have to get a private placement, a purchase or infusion by a private equity firm. There's going to have to be some sort of a transaction to bring in liquidity. And when that happens, one thing that we need to consider is, well, was that per unit rate greater than or lower than the per unit rate that we are recognizing for those equity instruments in private entities? And if it's lower, then we might have an impairment, because even though there might be an economic downturn, that is not considered a non-orderly transaction. That is considered a normal transaction as long as it's not with a related party and it's not part of bankruptcy. So you would have to consider those transactions. The next is equity method investments. The only thing I want to talk about with equity method investments, we're all used to what those are and the fact that you need to evaluate them for impairment like any other asset. The only thing I would say is that with equity method investments, there is a special rule that if you believe that the impairment is temporary, that you would not recognize that temporary decline. And I think that COVID-19 is going to exacerbate that judgment required to assert that there's a decline that is only temporary, because we're really unknown as to how long this might last. And then lastly, assets that are measured at amortized cost. These are your trade receivables, your loans, held to maturity debt securities, that kind of thing. The only thing I want to talk about with that is I don't want to steal Jessica's thunder. She's going to talk a little bit about perhaps some changes for some entities and the expected CECL adoption date later on in the presentation. But what I do want to point out is that many entities kind of apply a qualitative filter. And so they will look at their assets that are measured at amortized cost, and they will qualitatively decide whether they need to move forward with some sort of a quantification of impairment or not, based upon a qualitative filter such as credit rating declines. And so in this environment where things are changing so fast, those controls, those qualitative filters, may no longer be sufficient to identify whether or not a quantitative impairment analysis is necessary, because, well, some of the rating agencies might not have fully updated their ratings of that particular entity or taken into consideration new facts that are on the ground and that kind of thing. So controls might need to change a little bit there. But I promised you we'd talk a little bit about equity instruments. So I'm going to talk about the two most common questions that I get when it comes to equity instruments and impairment. And that is, okay, can a quoted price in an active market, so we're talking about level 1 fair value here, can it be adjusted or ignored in a period of significant market volatility, which I think we'd all agree we've seen, wild swings in the market? And the answer to that is unfortunately no. Generally, if it's a level 1, it's an active market, you need to use the quoted price in that market, even if it's very volatile, because you're only allowed to ignore a active market input if it's not considered to be orderly. So it's with a related party or it was under bankruptcy or that kind of thing. And so rarely do we see a transaction not be considered orderly. Similarly, there's another question that I get, which is, okay, maybe this isn't a level 1, but instead it's a level 2 fair value. So it's a quoted price in an inactive market that we're using as an input to determine fair value and whether or not there should be an impairment. And so here you get a little bit more leeway, okay? I would say that you can perhaps adjust the market price if there's been a significant change from that transaction date to the date that we're assessing impairment. but you generally cannot ignore it completely. You need to take that and factor it into your computation, unless, of course, it's not orderly. So a little bit of relief there. Let's move on then to talking a little bit about derivatives and hedging. So if I'm a company and I have routine inventory purchases or sales, say they're denominated in a foreign currency and I don't want to be exposed to that risk, I might enter into a cash flow hedge for a forecasted transaction, okay? So maybe I don't know exactly how many inventory purchases I'm going to make or exactly how many sales. It's not, in stone, but I can estimate it's a forecast. Well, in those situations, you are able to apply hedge accounting, meaning you would not have to recognize a gain or loss into income, and instead you could recognize it into other comprehensive income. You are allowed to do that so long as that forecasted transaction is probable of occurring. Now, because of COVID-19, many entities are decreasing their forecast and the transaction volume. So those inventory purchases might not be the same amount, or the sales might not be the same amount. And so that nominal value of that hedging instrument that you had might not, the hedging instrument might have a higher nominal value than what is actually now forecasted. And unfortunately, whenever a hedged forecasted transaction no longer becomes probable, hedge accounting has to end forever. And from that point forward, any changes in fair value would be recognized directly into earnings. Now, a little bit of relief, any previous gains or losses on that instrument when it did apply for hedge accounting would be kept in accumulated other comprehensive income until that forecasted transaction occurs or becomes probable of not occurring. Similarly, normal purchases and sales, and talk a little bit about that. And so entities enter into contracts all the time, such as long-term supply arrangements that have all the elements of a derivative instrument, a nominal amount, such as a fixed quantity of goods, a strike price, such as an established price for those goods, a contractual price, and an underlying, such as maybe if there's a commodity, that good is a commodity. And so that would meet all the definitions of a derivative, but derivative instruments are financial instruments. They're pieces of paper that you can be exchanged for cash or equity interest in an entity. There's not any expectation of physical delivery. So ASC 815 provides some relief, and what it essentially says is that if you are anticipating physical settlement, meaning that good or service is actually going to be delivered, and it's probable that that's going to happen, then you don't have to apply hedge accounting and recognize things through other comprehensive income, or derivative accounting and recognize things directly in income. You can just kind of ignore that effect. And so because of COVID-19, though, similar to the cash flow hedge issue, some of those normal purchases and sales might not occur. And so if it no longer becomes probable that it's going to occur, all of a sudden now you have a derivative on your hand, and you might need to recognize that change in value, into income or other comprehensive income, depending upon whether or not it's a fair value or cash flow hedge. The last two items I just want to touch briefly on, and that is, the long haul method and the quantitative to qualitative method. So both of these deal with, when you start off with a derivative, you have to quantify whether or not it is highly effective at offsetting the value of the underlying it's trying to risk hedge against. And so you're going to have a more long haul method calculations that are going to result in ineffectiveness. And also, there was an ASU that was released, I believe it was in 2017, that basically allowed you to have a quantitative analysis and then move towards a qualitative analysis going forward. Now, that qualitative analysis going forward was predicated on the fact that there weren't significant changes in facts and circumstances that would, render the original opinion derived through quantitative analysis incorrect. And so obviously with COVID-19, there might be some significant changes in facts and circumstances that might require an entity to perform that quantitative, a more cumbersome calculation going forward. So the next area that I see quite a lot of questions about is debt. And we all think about that when there's financial difficulties. And lo and behold, I always get the same questions on debt covenant violations. And so I think it's good to go over a reminder that, covenant violations that occur before the balance sheet date will require the debt to be classified as short-term, not long-term, unless there is a covenant waiver obtained. And the covenant waiver needs to cover at least 1 year from the balance sheet date. So it needs to be the lender saying, I acknowledge that there was a covenant violation as of, say, 12/31, and I will not call the debt for that particular covenant violation that happened on 12/31 for at least a year. And this is the part that I think a lot of folks miss. You also have to assert and prove that it's probable that you will not fail that covenant within 1 year from the balance sheet date. So if the lender doesn't waive all covenants or only waives that particular violation as of that date and not for 3 months in the future or 6 months, then you need to be able to assert that, well, we think that we've got this covenant, it covers a year, but also we think that the future covenants that we're going to be required to meet going forward over the next year, we will meet. And then, and only then, would you be able to reclass out of short-term and move it into long-term because you've obtained a waiver. Covenant violations after the balance sheet date are a little bit easier because they've occurred after the balance sheet date. They're considered a type 2 subsequent event, so they are not recognized. They are simply disclosed. And the other big issue that is a little bit beyond the scope of this course is when you have changes to your debt, whether it's changes to payment terms and that kind of thing, substantive changes, different interest rates, that kind of thing. You have to go through an analysis to determine first if it's a troubled debt restructuring or a TDR. And if it's not that, then you need to decide whether it's modification or extinguishment accounting. So I think that as a result of COVID-19, there are going to be more debt modifications in general, and more of them that will qualify as either a TDR or extinguishment, and let me explain. So with a TDR, you have to have experiencing financial difficulties, and the lender has to grant a concession. Well, now a lot of companies are going to be experiencing financial difficulties. So a financial difficulty might be that your credit rating decreased from an investment grade to a non-investment grade. There's a default, or there's a bankruptcy, or a going concern opinion, a delisting or a threat of delisting, that kind of thing. But assuming that you can get past TDR accounting, then you have to decide whether it's extinguishment or modification. And the three different accountings, TDR, modification, extinguishment, have profound impacts. So they have a profound impact on whether or not there's a gain recognized, immediately what your expense for interest going forward might be, and the disclosures, and then also the accounting for the fees that you might incur, such as fees of lenders and borrowers. And so with extinguishment accounting, which I think we're going to see more of because there's going to be a greater change in those debt instruments, when you have extinguishment accounting, you recognize a gain or loss depending upon the change in fair value from the new debt to your old modified debt. And that fair value of the new debt has to be based upon current market rates. So if your current market rates have greatly changed from that original debt, then you're going to have a greater chance of having extinguishment accounting, but also you're going to have really a greater impact that fair value is going to be significantly different. So those are some of the changes that I see with debt accounting and large macro changes and that kind of thing. And so with that, I think we're entering into our third polling question. Jessica?
Yep, so poll question 3. What do you think will be most challenging about performing your next reporting close? Whether it's performing it remotely with everyone working from home, having to prepare forecasts and projections due to uncertainty, addressing all accounting issues like we've been discussing, or evaluating subsequent events. You guys could go ahead and answer the question. You have to have at least 3 out of 4 of these answered to get your CPE credit. So I want to make sure you guys get that. few more seconds. Okay, Christy, if you want to go ahead and close the poll. So it looks like the largest percent is in preparing forecasts and projections, which definitely difficult when there's so much changing. Next would be 31% addressing accounting issues, and then 22% performing the close remotely. Only 8% saying evaluating subsequent events, which I think makes sense because while that's affecting a lot of people, it's definitely easier to figure out how to disclose something than dealing with things like projections and fair values and stuff like that. So with that, I'll pass it back to Michael.
Great. So the next category of changes that might be as a result of COVID-19 would be inventory. So, we're all aware of the lower of cost or net realizable value. Not much to talk about there other than there could be an impact. I think the area that I see a lot of misses in would be idle capacity. That is that manufacturing in particular, your inventory, it consists of, your raw materials, your labor, your direct costs such as that, but also indirect costs and overhead. And overhead costs are supposed to be absorbed in the inventory using a normal capacity, meaning, a normal amount of production over a number of periods. And so because of COVID-19, there could be significant decreases in the volume of production. And so essentially what the codification says is that, well, if you've had a significant decrease in production, it's not that your inventory all of a sudden costs more because you're having to allocate more of that fixed cost. Instead, what you need to do is keep the same standard costs and simply just expense in the period these unabsorbed costs, all right? Those are period expenses for idle capacity. And then the other area with inventory I want to talk about a little bit is just purchase commitments. If there are non-countable and unhedged purchase commitments, you might need to recognize a loss. The other area that's kind of big is leases. So with leases, I'm not going to go into too much here. Leases, whether it's a capital lease under 840 or a ROU asset under 842, the new lease standard, these are assets and they need to be evaluated for impairment under ASC 360. The next two boxes, force majeures and lease modifications, just to reiterate that if you have a change in your rent price and it's based upon a force majeure clause, that there's not any kind of modification accounting needs to be applied. But if it's not, then you would need to apply lease modification accounting. Then also your incremental borrowing rate. So the incremental borrowing rate for a lot of borrowers is going to change because of COVID-19 and the economic impacts. And so that change in incremental borrowing rate is going to have an impact under the old lease standard in determining what the present value of your lease payments is. And that could swing more things into capital lease treatment. And then also under the new lease standard, 842, it is used to compute what the present value of your lease liability is. So you might have a higher lease liability because of that. The next area I want to get into is revenue. And briefly touch on some of these items. Step one in the revenue recognition five-step process is, determine whether it's a contract. And part of that is that collectability is reasonably assured. So we really need to consider that, whether it's a new contract or an existing contract. If collectability is not assured, then no contract exists, and that can defer revenue for quite some time. Or if collectability relates to an existing contract, whether or not it's an allowance for AR or whether it is a contract modification. Healthcare entities, I just want to briefly remind everyone that you are required to disclose management's policy regarding charity care, which might change as a result of COVID-19. And last but not least, the variable consideration, being unable to meet performance obligations might result in penalties or not earning a bonus that previously was was thought would be earned. There could be increases in refunds or returns, that kind of thing. And then lastly, I want to talk a little bit on the revenue recognition of acts of grace. So one of in this troubling time, one of the beautiful things that we see is a lot of companies, providing maybe free or discounted goods or services or extended payment terms, that kind of thing. And so, when you have free or discounted goods or services, you need to determine whether or not those free or discounted goods or services should be combined with a contract because it was entered into or provided near the timing of another contract, or if they need to be considered a modification because there's an existing contract with that particular customer. And then extended payment terms. Obviously, you need to think about for new contracts whether those extended payment terms means there's a financing component, or if those extended payment terms are really just part of your AR allowance and that kind of thing. And so with that, I'll just hand it off to Jessica as we talk a little bit more about just kind of the overall impact.
Thanks, Michael. So just a few overall things that are less detailed accounting related. First, I want to talk about some regulatory changes because there's been a lot happening here over the last few weeks. First, let's talk about some reporting deadlines. So in early March, the SEC initially provided a 45-day extension. So that was for reports that would have been due between March 1st and April 30th. Then just last week on March 25th, they extended this to apply to any reports that would be required to be filed through July 1st. So to use this option, you just have to file an 8K that explains why your release is needed and how it relates to COVID-19, and then you get an extra 45 days to file. Last week, the SEC also issued some disclosure guidance, which provided some of the staff's views on disclosure and other securities law obligations that companies should consider just related to the current situation, business and market disruptions. The IRS, obviously, I'm sure you guys have seen a lot going on there too. So they released Notice 2020-18, and in this, they announced that the due date for the federal income tax returns and payments that would have been due April 15th are now automatically postponed to July 15th. And an important thing to note here is that while the federal income tax returns are postponed, many other important tax acts are not postponed to July 15th. And so that includes second quarter estimates. And there are still advantages to filing your return by April 15th. So that would be the ability to accelerate any refunds if you're expecting a refund. You could receive some important cash flow planning information, and then also potentially carry back losses. And also note that you can still file your return by April 15th, but postpone the payment of any taxes until July 15th. Then also with banks, many private companies have deadlines that are set by banks or other lenders. And so if you have a bank reporting deadline that you anticipate having an issue in meeting, we recommend talking with your bank as soon as possible to determine the best approach, see if they would be willing to grant any potential extensions there for you. So then there are some impacts and potential impacts to some accounting standards as well. So FASB has been working with banks, and they support that financial institutions won't automatically have to categorize all COVID-19 related loan modifications as troubled debt restructuring. So under US GAAP, a restructuring of debt is a troubled debt restructuring if the creditor is granting a concession to the debtor that it wouldn't have otherwise considered, and this is for reasons that are due to the debtor's financial difficulties. So FASB has confirmed that any short-term modifications that have been made on a good faith basis in response to COVID-19, as long as it's to borrowers who were current prior to any relief, these don't have to be categorized as troubled debt restructuring. So this includes short-term modifications such as payment deferrals, fee waivers, extensions of repayment terms, or other delays that are relatively insignificant. Next, large publicly traded banks were supposed to adopt the current expected credit loss, or CECL standard, on January 1st. But the CARES Act that was just signed into law last Friday now gives them either until December 31st or whenever this coronavirus national emergency ends, whichever comes first. So it gives them a little delay, and this is a very large standard for financial institutions, and so it gives them a delay in adopting that. FASB also announced yesterday that they're having a meeting next week to discuss potential deferrals for some other significant standards. So don't have details there, but definitely be on the lookout for some potential delays. And then finally, GASB, who creates the government accounting standards, has also discussed the potential to delay both GASB 87, which is their new lease standard, as well as GASB 84 for fiduciary activities that would be effective this year. So with all of these changes happening, there may also be a need for changes in internal control structures. So we recommend you continue to reevaluate your processes through these times. First, I'd recommend reassessing any entity level controls to ensure they're sufficient to address any changes in the risks due to changes in the economic environment. So for example, consider if there are new fraud risks related to management override of controls, or whether any new overall business risks have been brought to light, such as changes in liquidity or risks in a large number of employees being absent at one time. Also consider if changes in controls or processes are needed. So this could be due to remote working, or if layoffs or furloughs are needed. With many companies moving to fully or almost fully work from home during this time, there might be instances where controls can't be performed the same way as they have been. So approvals that used to happen manually may need to move to electronic, or processes may need to change to keep the flow of information moving to the right people. And then finally, considering whether to add any new controls into your processes. Just making sure all gaps are covered based on the changes to situations. So that brings us to our last polling question. So what is your current plan regarding timing for your next issuance of financials? Either issue on normal timeline, delay issuance, still determining, or not applicable? I'll give you guys just a few more seconds because we're running out of time. Chrissy, do you want to go ahead and close the poll? Okay, so the majority are saying they'll still issue on normal timeline with 66%, and then 22% still determining. So there's so much happening so quickly. It's definitely overwhelming to keep up with everything. So Cherry Bekaert is here to help guide you through this time however we can. So here's a quick look at some ways we can help. We can help with preparing cash flow projections to quickly assess the steps to take in order to restore the financial health of your business, provide working capital management services to help provide access to a line of credit, working capital, helping clients of all sizes access new debt and capital sources. We can provide assistance in accessing federal and state stimulus packages. So big thing here, the SBA loans, helping you complete the applications and the compliance reporting. We can create data analytic dashboards to help monitor crisis KPIs, for example, mapping daily COVID-19 cases against your footprint, and helping to automate management of those KPIs specific to your industry. As Michael mentioned, there's potential for business interruption insurance claims. So each industry might be eligible for different types of claims, but we can help in reviewing policies and claim calculations. And then the CARES Act made important changes in tax codes to help generate more tax deductions. And so we can assist in reviewing these impacts and how to best increase your deductions and maximize your refunds. And then finally, we talked through a lot of different accounting impacts. And so we can also help tackle some of these more complicated accounting areas, such as impairment, debt modifications, all of that. So if we can help you with any of these things, please reach out to either Michael or myself or your engagement team if you have other contacts there. For more information, if you want guidance on these topics, tax impacts, SBA loans, all the different federal acts that have come out, we have a COVID-19 guidance center, and you can find that through our website at cbh.com. So sorry, we were about a minute over. We've gotten a lot of questions, so we'll try, for the ones that we weren't able to respond to during the presentation, we'll try to get back to you guys with some answers. But really appreciate everyone's time here. Thanks for joining us. We hope you got something out of it and hope you guys are all staying safe and healthy.